Most people spend their time asking how high Bitcoin can go. The better question is the opposite. How low can it realistically go before the probabilities start to flip? Because bottoms are not found by guessing one perfect candle. They are built when multiple independent models start pointing to the same lower zone. So in this video, we're going to strip away the noise and use hard quantitative evidence to answer one simple question. Where is Bitcoin's real floor likely being built? Let's start with the yearly Sortino ratio. This is not some niche crypto oscillator. The Sortino ratio is one of the most respected risk-adjusted return metrics in all of finance. Hedge funds use it. Portfolio managers use it. And its job is simple. It tells you how much return you're being compensated for relative to the downside risk you're taking. That distinction matters. Most people are more familiar with the Sharpe ratio, but the Sharpe penalizes all volatility equally. If price explodes higher, that counts as volatility. If price collapses lower, that also counts as volatility. For Bitcoin, that is a problem, because Bitcoin is structurally volatile to the upside. Its explosive rallies are part of the asset's return profile. The Sortino ratio fixes that. It focuses only on the bad volatility, the downside volatility. So instead of asking whether price is moving a lot, it asks whether you are being properly compensated for the downside stress you are absorbing. And when we look at the yearly Sortino ratio, something very clear emerges. The best long-term Bitcoin accumulation windows have historically begun when the yearly Sortino drops below zero. That is the important threshold. Once the metric turns negative, downside volatility has dominated returns over the prior year. Historically, those are the periods where the market feels worst in real time, but where the long-term opportunity starts becoming most interesting. That does not mean the instant the Sortino turns negative, the bottom is in. It means the market has entered a zone of interest, an allocation window, a regime where stress is elevated, downside has already been realized, and long-term asymmetry starts improving. That is how this metric should be used, not to catch one exact bottom candle, but to identify the period where trying to be too precise matters less than simply getting positioned inside a historically strong risk-adjusted window. Now let's move to the second major model, the logarithmic risk model. This model asks a different question. It does not ask whether Bitcoin is cheap relative to one moving average or one recent range. It asks, how risky is it to allocate at this point in the cycle? The model measures Bitcoin's over and under extension relative to a time-weighted logarithmic average, and then maps that into a risk scale. The heat map makes it intuitive. Dark red regions represent periods of extreme risk, which typically form near cycle tops. Light regions represent periods of extremely low risk, which historically show up near cycle bottoms, and that is what makes this model so useful, because it does not try to predict next week's candle. It tells you whether the cycle asymmetry is shifting. When the first light-colored areas begin printing, that has historically marked the start of the bottoming process, not the end of it. That is a crucial distinction. Bottoming phases have not been short. They usually unfold over months, so the point of log risk is not to say this exact day is the final low. The point is to say we are entering the part of the cycle where risk is becoming materially lower and long-term positioning becomes statistically more attractive. And if the market continues to deteriorate from there, risk can keep compressing even further. But the key is that once the model moves into those lighter low-risk regimes, the long-term game changes. The asymmetry starts becoming much more favorable than most people emotionally realize. Now let's add structural confirmation. The 200-day and 365-day moving averages are not floor models by themselves, but they are extremely useful market state filters. The 200-day moving average is one of the most widely used long-term trend filters across all risk assets. The 365-day moving average smooths Bitcoin across a full macro year, and when price is below both of them at the same time, that tells us something important. The path of least resistance is usually still down, or at the very least sideways and weak. That does not mean panic. It does not mean collapse. It means the market has not yet re-established broad trend strength. For this video, that matters because it tells us how bottoms are usually built, not through instant reversals, but through prolonged periods where price remains under major trend filters while the deeper floor models begin improving underneath. So this chart does not give us the floor, it gives us the context in which that floor is likely being formed. Next is the z-score probability model. This chart measures how statistically stretched price is relative to its own history, and the important thing about z-score is that it defines extreme zones, not exact turning points. Historically, when Bitcoin enters deeply negative sigma territory, it is already in a part of the cycle where downside becomes statistically unusual. That does not guarantee an immediate reversal, but it does tell us we are moving out of ordinary correction territory and into the kind of window where floors typically begin to form. So z-score confirms the same thing. Downside may still exist, but the probability distribution is already starting to improve. Then we have the logarithmic growth bands. Bitcoin does not grow in a straight line. It grows exponentially over long periods, and these bands help map that long-term trajectory. The lower bands are especially important because they act like a structural fair value floor. As Bitcoin matures, that floor rises over time. That is the key takeaway. Old cycle lows become less and less relevant as reference points because the market's long-term structural base keeps moving upward. So even in a very ugly bear market phase, Bitcoin's realistic floor is not static. It evolves higher with the network itself. Now, one important distinction. A floor zone does not automatically mean expansion has begun. Price can become statistically attractive while the market still remains in accumulation. That is why the regime engine matters. The floor models estimate where downside becomes more bounded. The regime map tells us whether the market is still in persistent downtrend or consolidation, or whether it has actually transitioned into a new environment. So the models in this video estimate value. The regime engine classifies state. Those are two different problems. All of these indicator charts are completely free on SigmaQuant Lab. You can track the Sortino ratio, the log risk model, the z-score model, the structural moving average context, the log bands, and more directly on the site. Core is where those signals get translated into the full regime framework, with the full regime map, posture context, research notes, and backtests. So if you want the floor models, they are free. And if you want to know when those floor conditions actually start turning into a new market regime, that is what Core is built for, because markets are systems, not indicators.